The new break even for entrepreneurs in their businesses, or what I call the upside down budget that's based on you, the entrepreneur, not based on anything else, and it's not constraining. It's exactly the opposite. What is upside down budgeting? Upside down budgeting starts with you. And I will be creating other videos on this, but for now, we're just going to start with you, and we're going to pretend that you want to take home $5,000 a month out of your business. We're going to talk about the new break even for entrepreneurs in their businesses, or what I call the upside down budget that's based on you, the entrepreneur, not based on anything else, and it's not constraining. It's exactly the opposite. So let's dive in and let me show you upside down budgeting. All right, here we are. So what is upside down budgeting? Upside down budgeting starts with you. And I will be creating other videos on this, but for now, we're just going to start with you, and we're going to pretend that you want to take home $5,000 a month out of your business. That, to me, is the number one thing that you should know before you start budgeting. It's about you. Remember that. You're the star of this show. So, cool. We know we need to take $5,000 home a month. Now let's pretend you're a coaching business, and let's now work on a break even, or our upside down budgeting. I know that when all is said and done, I want my net income number to be $5,000. So instead of starting from the top down with revenue, we're going to start at the bottom with what is our net income, cash-based net income need to be each month so that I can pay it to myself. Now, I'm not going to get into the discussion of is it salary or is it owner's draw. We save that for other videos, and there's tons of them out there that I have on that particular topic. But one way or another, we want to hand you $5,000 because this is what you've decided you need to live. Hopefully by now I've talked enough and emphasized enough that you is the most important thing in your business and what you want to get out of it. Now we're going to build our budget. So now we're going to look at what we call the fixed expenses portion of our budget. And the fixed expenses are the things that we just have to keep the lights on. What happens whether we have clients or zero clients? So these happen no matter what. If we have one client, they happen. If we have zero clients, they happen. If we have 1,000 clients, they happen. Okay, now I know it's not as pure and clean as this, but it's the concept I'm teaching you now. What kind of stuff does this include? This includes, I'll call it travel. This includes software. This may include rent and some utilities and stuff that you're going to have to pay whether you have a client or not, especially if, say, travel's part of your PR. That's how you advertise. And let's say you know your travel every month is going to cost you $800 and your software costs you about $1,000 and you pay rent on a small... Hey, this is not a glitch. Stop. Don't scroll past. At Priorities Group, we offer everything from group finance mentorship programs designed especially in entrepreneur speak for entrepreneurs by an entrepreneur, all the way up to one-on-one business strategy and finance coaching, and also full service done-for-you bookkeeping and fractional CFO services. We focus on one thing across all of those offerings, using our expertise to help you optimize your business and reach your personal financial goals. So whether it's a mindset block or a cash flow block or any kind of block, we have the solution for you if you're an entrepreneur who's ready to put your financial house in order. Click below to take a quiz that's going to help us find out exactly what will help you most. Office for $500 and you pay utilities of $50. So our total fixed expenses are, in this particular case, do the math right in your head, Pam, $23.50. Okay? So here's what we know. We know that number one, our business needs to make $5,000 to give us. And we know that number two now, our business needs to make $23.50 to pay the bills to keep the lights on so that we don't have to close the business down. Piece of cake. So let's add those two numbers together. And what does that tell us? That tells us what I consider to be the most important number in the business. Because it doesn't matter how you get to that number from the top down. It matters that that number is the right thing from the bottom up, because we got you and we got your fixed expenses covered. So we know we need that number to be at least $7,350, which is the sum of these fixed costs, number 2, and number 1, paying you once a month. So that number, what is that called? I call it the contribution margin. And the other thing you've now learned is that that is your break-even number. That is how much contribution margin you need to pay for your fixed expenses and give you $5,000 a month. So now you say, okay, that's great. What does that tell me? Well, there are only 2 things that go into the contribution margin. It's your revenue, which is the dollars you get from your clients or customers, whatever you call them, minus the direct costs associated with providing that, which is called cost of goods sold. By direct, I mean if you have 0 clients, then these costs are 0, right? No matter, so these only happen if you have clients. And that's why we call them direct costs. They're also called variable costs. They're called cost of goods sold. They're called direct labor, direct materials, all sorts of things. But essentially, best way to think of them is direct costs, because they're directly related to providing the services that you need to provide, or the product you need to provide in order to get your revenue. So we know that that needs to be $7,350, and we know that that is revenue minus cost of goods sold. So what we need to know here is a number called profit margin. What you know is that you need to have enough left after your revenue to cover those costs. And let's say you have products and those products cost $10,000, and that your expenses for those are, let's call it $5,000. So if you sold one thing, you would get $5,000. Well, that's not enough to hit your break even, is it? No, it's not, because you know that you need to get $7,350. So this is a 50% profit margin. You know that your revenue's 10, your costs are 5, so you have a 50% profit margin. So how much do you have to sell so that this 50% of it comes out to $7,350? Well, very simply, here's the tough math part, but very simply, let me do it in a different color because it is a little bit of hard math here. You divide that $7,350, let me find a little space here to do that. $7,350 divided by that contribution margin equals 0.0714, 14,700. So we know that we need our revenue to be 14,700, and that our costs are going to be the difference between those two, which is 7,350. So we have now found our break-even revenue number. Okay? It gets more complicated if you have more products, but this is your break-even. It's your upside-down budgeting. We start with number 1, which is I want to pay myself $5,000. I need to cover my fixed expenses. Therefore, number 3, what does my contribution margin need to be? Number 4, what is my profit margin? PM. You divide number 3 by number 4, and you get your break-even revenue number. Let me just go over here and give you the little formula a little more clearly. Okay? I'm just going to do this with some different numbers so you can follow it. Say you want you to get $5,000 a month. Say that our fixed costs, I won't list them all out, but let's say they are, $10,000 in this example. So we know we need to make $15,000 in that contribution margin, right? Because that'll cover our fixed costs and cover paying me $5,000. So let's say that we know that our profit margin or our contribution margin percentage Let's say this time it's 40%. And we're going to say every time I sell something, I keep $1, I keep 40 cents. So how much do I need to sell to keep enough 40 cents to get $15,000? Well, that's pretty easy. I divide the 15,000 by 0.4, and there I get, I believe, $60,000. Don't know if I'm right there, but I could be. $60,000 in revenue. I shouldn't do that in my head. Minus 35,000 in costs, and that number there is just the 60 minus the 15. And now I know my break-even revenue is $60,000. So I got to make at least $60,000 in revenue in order to pay my fixed expenses, check, and me $5,000 a month, check. Okay, one more time, just with some different numbers, because sometimes when I say things differently, it'll sink in differently, and the math is a little complicated, but it's not too awful. Remember, we're doing this upside down because you are what matters, and we want to pay you $5,000. Let's say that our fixed expenses are $10,000, so we know that we need to make $15,000 no matter what. And let's say we know that our contribution margin percentage, from the exercise we did in the video that's linked below on profit margin, got you there, is, let's just say it's 30%. This time. I can't remember what I used in the last example. Hang on. Yeah, we'll make it 30% this time. So I have my me expense, which we'll call A, my fixed expenses, which we'll call B. A plus B equals C, which is my total that I need to make in the business in contribution margin. D is our contribution margin percentage. So we know that for that to be our contribution margin, we're going to have some amount of revenue, let's call that E, and we're going to have some amount of direct cost, let's call that F, and we know that however things turn out, this is going to be 30% of revenue, and guess what? This is just math. This is going to be 70% of revenue, because these two numbers here will always add up to 100%. That's just a little aside that you can always know that's what this is going to be here. That's how we'll do this math. Now, what are we going to do to figure out what our revenue needs to be, what our direct cost needs to be? We're going to take this total C and we're going to divide it by D. C, which is our total that we need, and the total that we need is fixed expenses plus me, what I want to take home, equals C. D is our contribution margin percentage. C is 15,000. D is 30%, which is 0.30. That comes out to 4,500. So since we know that comes out to 45,000, since we know that comes out to 45,000, that goes right in here as our revenue number. Okay? And the difference between the 45 and the 15 is our direct costs. We know that because we've already calculated what our contribution margin is in another thing. If we do all that, it's beautiful because we have a profit and loss statement that looks like this. Revenue of 45,000, direct costs of 30,000, contribution margin of 15, revenue, direct costs. And we have our fixed costs on the P&L, which we know is 10. And guess what's left? Net income, or the money for me. This is how most people talk about it, top to bottom. We just built it up from bottom to top. Because what's the most important thing? You. Remember, it's all about you. And master your mindset, you'll master your money. Let's make sure that we're always focusing this on you. I hope that was helpful. Drop any questions you might have below in the comments and we will definitely answer, maybe even with another video. Take care. I hope that video was helpful and I hope you subscribe to my channel for more information on finances in your business.